All right, good afternoon and welcome everyone to Trilogy's quarterly market commentary for Q2 2026. I am Caitlin Spain, our product operations manager, and we're joined here today with Mike Serio, our Chief Investment Officer here at Trilogy Financial. This is a 45-minute session today, and we'll spend the first 30 minutes with Mike sharing economic perspectives and market insights that will connect the dots from the past, shed some light on what's going on right now, which we know there's a lot going on right now, and help us navigate some of what's ahead. We'll have about 15 minutes for Q&A at the end of the session. If you do have questions during the call, please email us at investment.team@trilogyfs.com. It's here on the screen. You can send emails there with your questions, and I will moderate those at the end. Let me introduce Mike Serio. Mike is the Chief Investment Officer at Trilogy Capital, responsible for investment strategy and client communications, where he oversees $4 billion in client assets. He has over 30 years of Wall Street experience as a portfolio manager, strategist, and chief investment officer. Mike has been frequently quoted in the Wall Street Journal, the New York Times, Bloomberg, the Washington Post, and other publications. He worked on the Russian project for the United States Agency for International Development in the formation of capital markets in the former Soviet Union. He's also a former adjunct professor at the University of Denver and DePaul University. He earned his bachelor's degree in economics from the University of Illinois, an MBA in finance from DePaul University, and he's a CFA, a chartered financial analyst, as well as a CAIA, a chartered alternative investment analyst. Mike, we're excited to hear from you today. The floor is yours.
Great. Thank you, Caitlin. A lot going on, as you could probably see. I want to start out with some quotes that kind of give us an idea of what the situation looks like. So the first one's going to be on our duty at Trilogy. And I know a lot of people out there have the news on. I personally have CNBC or Bloomberg on all day, with the sound off, actually, just to see what the markets are doing on a minute by minute basis. But I'll tell you, there's a lot of talking heads out there, and it's easy to talk about things. But I want you to know that our job is not just to talk about things, but our job is to be a steward of your wealth. So we always like to say there are those who predict rain and those whose job it is to build arcs. And I want to let you know at Trilogy, it's our job to build arcs. And it's a little harder than just getting on TV and spouting off about something. When I went to media training school in another life, they told me, number one, be smart. Number two, say things in multiples of three, which is what I'm doing now. And number three, make sure they know where you're from, because in 3 minutes, they're not going to remember anything you just said. So remember that. The second one is on politics, and I try not to even broach any of that. I was in Washington, D.C. 2 weeks ago, and it's just amazing how polarized this country is. And again, our job is a little different. Our job is to take the environment out there, and I don't care what that is. I actually care what that is, and manage your assets accordingly. And the quote here is from the movie The Fugitive, when Sam Gerard was catching Dr. Richard Kimball, and Harrison Ford said, "I didn't kill my wife." And Tommy Lee Jones said, "I don't care." And it's not that we don't care about politics, but that's not our job. Our job is to manage money given whatever environment we're in, because at the end of the day, economics is a dismal science. And I hate to say that, but I'm going to show you some examples of that. So what do we want to discuss today? Some general macro comments, which we always do. I want to talk a little bit about the war, midterm elections, and what, historically happens after. We're going to talk about the longer term view of the dollar, where are the opportunities, and as Caitlin said, give you some time to email in some questions and or comments. But let's get to what we know. Believe it or not, the U.S. economy has weathered the war shock extremely well. And I think we were in a much better shape than pundits or even experienced economists had thought. When you look now, we're a couple months into this, we have seen limited layoffs, solid manufacturing, and a good harbinger of what's going on are vehicle sales, because people don't buy cars or new cars unless they feel really good about their employment situation and the amount of money they have coming back to them. We will say inflation remains a concern, and this is a different type of inflation that longer term inflation is about. And longer term, it's about a lot of money chasing too few goods. We say that's a monetary phenomenon. What this is an input phenomena, just like the supply chain shocks were 3, 4 years ago. This is an increase in oil, like we saw way back in the early 70s, the Arab oil embargo. And in this case, when it does subside, it's going to take a little longer, and I'll talk about that. When you look at the equity, bond, currency, and markets, it's almost trending identically to the average midterm election. I'll show you some charts on that. So what we're going through now is not a surprise. Equity markets get to be more defensive in the middle of midterm election years. But what's interesting is the S&P has not declined in the 12 months after a midterm election since 1938. And that's extremely interesting. So when you look at eras of crises and events, and this kind of hard to see, but this goes all the way back to 1970. My career has spanned the right 2/3 of this, believe it or not. So I've seen a lot of crises. I've seen a lot of events happen. And in every single case, they were buying opportunities. The worst event being happened in and around the end of last century when we had 9/11, we had a war, and we had a recession, or a pretty bad one. And we did have 10 years of flat equity performance. But in every other case, it's been a great opportunity to buy. And here's an interesting one, but I have to get this deck to compliance about a week ahead of time. So here's the sell-off in perspective. You've seen this has only been the fifth worst sell-off since the year 2000. Now we're only a little over halfway through the decade, but it's not that bad. So when I drew up the chart, 70% of the decline had already retraced itself. So this line is actually upward sloping. And as I'm looking at my TV on the left, I'll see that the S&P is up a little less than 1%. And I'm guessing we've probably now gotten back everything that the market went down, and we've retraced the bottom. So this is a good lesson in being somewhat optimistic and knowing that things do work themselves out. Because if you look at the U.S. stock market returns after major geopolitical shocks, this one's a little harder to see, but you'll see there's some pretty bad ones here. Pearl Harbor, Iraq's invasion of Kuwait et al. You see that when you go forward about a year, with the exception of the U.S. terrorist attacks, that's that lost decade I just mentioned, we've had some really, really good equity returns off of those lows. Now, the other thing we have to discuss is we are in the midterm election, and you'll see what we've gone through is normal. You'll see market corrections during years of midterm elections, and you'll see on average, they average, on average is about 11%. We know during that calendar year. And what we just went through was 9.1%. So it's not exactly the worst situation we've ever had. In fact, it's not even to the average bad situation we've ever gone through. And again, this one goes to 1962. And so when you look at the average S&P price returns over the 4-year cycle, that's on the left, you'll see usually year 2 is a little rough, and you do get that drawdown. And that red line, which is the Trump term right now, and this goes all the way back to 1961, so it's a pretty robust set of data, as we say in economics. It's following almost right on top of what we would expect it to be. So that's really good. And a lot of that has to do with uncertainty. When you have an election, and most times what you'll see is a changeover of the House or the other branch there, and then you'll see a lot of uncertainty out there, and that's not good for markets. That's not good for businesses and planners, because they do need certainty on tax rates and depreciation rates and all those other things. And when the midterms have a tendency to shift over Congress, you do get a lot of uncertainty there, and you do get a lot of choppy stock markets. But then when you look on the right, and again, this one goes all the way back to 1942. You'll see the S&P 500 price returns 12 months following the midterm elections, and that's average 14.8%. You can kind of surmise that there's more certainty in the market, and people and markets do like that, and that's really a positive thing for stock market returns. Let's get to the oil business in a second. And if you've been watching on TV, you'll know that Strait of Hormuz is very important, not just geopolitically, but to move commodities in and out of that area. You'll see oil, about 20% of all global oil gets moved through the strait. Liquid natural gas, liquid petroleum gas, a good portion of that. People don't realize helium and, most importantly, fertilizer inputs, which have a lot of hydrocarbons in them and are very important for the world economy. That amount moves through that strait. Now, for the United States, it's not that big of a deal because only about 1% of what we use moves through there, and I'll get to that in a second. But it's more important for China. And our sources tell us this is not just trying to get rid of a country, not get rid of a country, but a regime whose doctrine was death to America, death to Israel, death to Europe, and had 11 nuclear warheads. But there's an upcoming talks with China, and China gets a significant amount of their energy through that strait. So we're moving from more of a military situation to an economic situation. Now, why is the oil and gas business important? And if you look on the left side, this is a business I actually took 2 years out to try to be a landman. If you ever watch the series, it's not quite as dramatic as the series is, but a lot of what they say in there is true. So if you look at conventional drilling on the left, so the first 100 or so years of the business was conventional drilling, and a little story on how this works. You'll see the oil and gas filled shale that's created by organic matter falling into low-lying areas. Fast forward 100 million, 200 million years, you get rocks and everything, compress it, and under immense amounts of pressure, that organic material then cooks into oil, gas, coal a little higher up. And then over long periods of time, that high pressure wants to release, so it goes to the low pressure area, which would be the atmosphere. And what geologists at the time looked for was that impermeable caprock you'll see there. It would look like an upside down bowl, and it would trap the hydrocarbons in there. They would look for those areas. Conventional drilling would go down and extract those hydrocarbons. Now, the doom and gloomers looked at as late as 2008 something called peak oil, that all the easy oil in the United States was already extracted. And if you went to Saudi Arabia, you could take a handgun, shoot a 45 into the ground and it bubbles up because their extraction costs are so cheap and all the oil is really easy to extract. And that was going to be the end of the world. We were going to go into an economic depression, and Saudi Arabia was going to control the world. Now, the beauty of the United States is capitalism and the free market economy and the profit motive had some very smart people starting about 60 years ago. And they asked themselves on the right side, what if we did something a little different? Took that bit, went down as far as 2.5 miles below the surface. Technology had come to the point where we have a pretty good idea where that oil and gas filled shale is, or what we call the pay zone. If we could take that bit, turn it sideways, move it another 2 miles down that pay zone, and then maybe frack it, maybe not frack it. Frack it is little explosions and sand fills the gap, and you extract the oil straight from the pay zone. Now, at the end of the day, what we see is we now have about 5 or 6 generations more of BTUs under us than we originally thought we had. Really great. And what that has done for us is, number one, is made us from a net importer of energy to now a net exporter. You'll see on the top right, U.S. crude production started to fall around 1974 and troughed in and around 2004 to 2008. But you'll see the shale revolution, what we just talked about with unconventional oil and gas, then you can see how fast that line went up between 2008 and the present. And you'll see below U.S. crude oil exports monthly, thousands of barrels per day have gone through the roof. So we are now more of a provider of energy to the world than we are a user. And what that has done at the end of the day is lower our dependence upon what was going through the Strait of Hormuz, lowering it on anything else. And again, we now produce enough energy for us to use ourselves. Now you're going to ask, why are oil prices rising? The thing is oil and natural gas are globally traded commodities, so it's going to be the average price around the world. And we can get into that a little more if you wanted to talk about it. Okay, here's another good thing going out there. And this is going to be a short-term phenomenon. And this is individual tax refunds are what we call sterilizing the price of oil. So the amount people are getting back from over withheld taxes is much more than what oil and gas or what gasoline is costing them at the gas station. Now, as I said, economics is a dismal science. This is for the country at large. That's the way we look at it in economics and in the markets. It's not evenly distributed. You're going to have people that use a lot of gas that aren't getting tax refunds, so it's not good for them, and vice versa. It's good for them. But as an economy goes, this is it's going to be a short-term phenomenon. It's only going to last for another month or so. So we've got to get this, and I'll talk about the window. The window's got to get closed on this war fairly quickly, or we're going to have a different environment to invest in. Now, I've been out on the road talking to a lot of clients, and an event does not go by where some bright client asks, is the reserve currency of the world status going to continue with the United States or not? That's a very good question. So when we look at history, we can go back to this, what we call exorbitant privilege of having the reserve currency of the world all the way back to Roman times. You can see a couple hundred years, the Romans had it, all the way up to Florence after the Dark Ages to the Netherlands. The UK had it until World War II, a little over 100 years, and now we are the reserve currency of the world, and it's just been over 100 years. So there's really no guarantee that this will be going forward. But I will say the answer is it's going to be at least in our lifetimes, and we'll talk about this in a second. Now, what are the benefits of that reserve currency status? Number one, lower borrowing costs. We can sell our debt abroad and to people who really want to go into some type of riskless asset. And because they don't have to worry about currency movements, they can go buy the US dollar and go into treasuries because a lot of currencies are pegged to the US dollar. There's that exorbitant privilege that we don't have to worry about currency movements because oil and most commodities, I'll talk to you about that in a second, are bought and sold in US dollars. There's trade benefits. We can finance those deficits more easily. There's geopolitical leverage that a lot of companies will put their reserves in our banks. And when you get in a situation like Russia invading the Ukraine, we can freeze those assets. And there's global liquidity and stability as a safe harbor that attracts foreign direct investments. A while back, I guess we're going on about 18 years right now, there was a situation where the US dollar was rated AAA. The rating agencies came and knocked it down to AA plus, and I was running a desk here in Denver, and it was amazing. I've never seen this. So the world kind of was panicking. So what did all these countries do? They sold their assets, they sold their currency, they bought US dollars, and they bought the treasury. So the treasury got downgraded, yet the demand for it rose because of we were the reserve currency of the world. So that's where that exorbitant privilege comes from. So what does it take to be that reserve currency of the world? You need to have a media of exchange, easy way to transact it, unit of account, it's got to be stable, and it has to be a store of value. So if you look at medium of exchange, right here, you'll see that when we trade, you'll see the US dollar on the left and the currency, and Americas being that second column there. Obviously, when things are bought and sold under the old NAFTA agreement through the Americas, about 96% of exports and imports are done using the US dollar. You'll see the Asia Pacific, 74%. You'll see Europe down to 66%, but that was the reason for the monetary the formation of the monetary EU, where France could trade with Italy, who could trade with the Netherlands, all in the same currency. And they have a little bit less use for the US dollar, but still 23% of those transactions are in the dollar. And then 79% of the rest of the world does it through the dollar. So you can see as a medium of exchange, that's still pretty robust. The second one would be unit of account. There's two seminal white papers, one by Waller. Just to sum it up, the research finds that the dollar's usage as an anchor currency has increased over the past 2 decades. This was a report that came out in 2004, and back in 2019 by a number of other economists. The US dollar scores as the world's dominant anchor currency by a very large margin. So we're not worried about that. So let's get to that store of value, where a lot of countries will store their currency in US dollars and in US treasuries. You'll see this goes back to 1999 or so. In the light blue area at the bottom, you can see we've lost a little bit of market share, but still it is the dominant currency in the world. You'll see Swiss franc, Japanese yen, China et al. A little bit of market share there, but again, not a lot to worry about. Let's get to a couple other macro comments. One way, and this is kind of fun, that we look at the economy as a way consumer spending. And one of our new research partners, Evercore ISI, who I've been following for a long, long time, we have them on board now. One of the things they look at is the consumption of liquor versus cheaper spirits versus liquor and beer. Okay, that when the economy's not doing well, people swap out scotch, they swap out more expensive gin and vodka, and they start drinking beer. And when the line's going down, things don't look very good. I thought this was always kind of fun to share with clients. My guess is a lot of this is the new generation just doesn't drink as much as us boomers. So good for you guys. You're going to stay alive longer. But it's making this a little bit more inaccurate than we want it to be. But a better way to look at this are economic surprises. Now, what's an economic surprise? Every piece of data that comes out, if you watch TV, there'll be a consensus expectations. These are all the economists polled look at the unemployment rate, say, and if they think the unemployment rate's going to be 4.3 and it comes out at 4.0, that's an upside surprise. So that goes into this index. Same thing with inflation, same thing with a number of different inputs. And you can see, at least as of 4/1, which is just a couple weeks ago, the economic surprise index has been going through the roof. And that's going back to the strength of this economy, and that it's much more robust, much more strong than actually most people had predicted. The problem is optimism and pessimism. And here's an index that looks at, like economic surprises. This polls people and businesses to see if they're pessimistic or optimistic. And you can see when it's high, that's excessive optimism. This is situations like we had in 2000, where everybody thought they didn't care about prices of internet stocks and everything's going through the roof. Don't worry about it. A little bit of the Magnificent Seven we had a couple years ago. Don't worry about it. And in those cases, our job, myself and our investment committee, who is just the super people working on the investment committee, we start asking ourselves, if everybody's over optimistic, what can go wrong? Now, what I have learned over the many decades in this business is that pessimism breeds opportunity. And when that line goes down, you have to start asking yourself, what can go right? And so that's an optimistic thing to a little contrarian, so to say. So let's go to our tactical themes as we finish up. We think there's going to be slightly more unrest. The demand for energy is still going to be high given the amount of energy consumed by AI. Commodities, Japan, inflation and affordability, and then capital spending on artificial intelligence, which I'll start with. So you'll see this looks at office center construction versus data centers. And you can see since call it 3 years ago. We all know, and this is kind of obvious if you've gone to downtowns in a lot of different cities, that office construction has basically come to a halt. And there's a lot of what we call see-through buildings out there, buildings that are just not being occupied. Part of it is a post-COVID phenomena of people working from home. Well, the other thing, on the contrary, are data centers. They are going through the roof, and we are investing it in them in a way through the Strategas ETF. Now, what gets me a little concerned is this getting a little too optimistic for me. And it's how you invest in it rather than investing in it, because I think a lot of companies out there are throwing money at it. I think AI will pay off at some point, but in case it doesn't pay off, there's going to be some unhappy people out there. So we're looking for liquid investments to go into data centers rather than going into the real estate that's under there where clients might be locked up for 3, 4, 5, 6 years, and that's important. Here's a really interesting chart. Speaking of AI, looking at human written words back to 1500. And you can see in black that's going up. And I looked at that chart. I go, what is that blue squiggly line? Somebody may have gone a little weird on their PowerPoint, but that's actually the AI written words right there. And it's amazing that there's much more production of written words from AI than there is from humans. And I think that goes two ways. Two things to think about is, number one is AI is here to stay. You're going to either have to embrace it or you'll probably turn into the next dinosaur. And number two, our children are going to have to work in their careers how to AI proof their careers going forward. You're either going to use it or know how to use it, or there's a good chance you might be displaced. Now, the other thing, as these data centers get built and their appetite for power comes in the form of utilities and building more of those. And then what we're going to need are many more, especially industrial commodities. And you can see we take a look at commodities undervalued or overvalued versus US stocks. In the short run, commodity prices are determined by demand. There's a lot of demand out there and supply stays the same. Prices go up. Longer term, more commodities will be produced, or because sometimes it takes a long time to get production out of a copper mine. It's given that it's about 15 years between when somebody puts it on the drafting board and you actually start mining copper. But adding, and if you look at the bottom, adding capacity is expensive and takes many years. So we are starting to get pretty optimistic on not just industrial commodities, but if you're in our tactical portfolios, you'll see some gold and some agriculture too. Finally, we want to talk a little bit about the government. One of the reasons gold has done so well, it's given a little bit back, is because of the spending that our government, and this is a bipartisan issue, it keeps going up and up. There's some people out there and some investors out there will say, boy, rather than those treasuries we're buying, why don't we put in the gold? And then it turns into fear of missing out, and high prices beget high prices here. And you can see what gold has done. It's at about a 5,000 year all-time high. We have positions in it. If we see it going down, that might breed some opportunities. So if you're in our tactical portfolios, you'll see through either the GLD ETF or the PICK. Those are ways to get into it. So be aware that we are looking hard and fast at commodities. And then finally, one of the reasons we're spending so much is government projections are often way too optimistic. You'll see going back to 1966 what the projected cost of Medicare was. With inflation, it was only supposed to be down there. Now, 1966 isn't that long ago. You can look at the population growth and get an idea when you fast forward it 60, 65, 70 years, what that population growth would be. But you'll see the actual Medicare cost is through the roof. And then you have Social Security. This is a famous statistic, Ida Mae Fuller. was the first recipient of Social Security. She retired in 1939 at age 65. She died in 1974 at 100. She put $24.75 in the system, and she collected almost $23,000 in benefits. So I don't know. Those numbers don't work to me. I don't know if it's that bad right now. But something's got to happen with Social Security because we can't go on with this, and that's going to be the big one. We'll let the politicians handle that. So let me finish up with one of my favorite quotes. It's from Eric Sevareid back in the 70s. It's the biggest big business in America is not steel, automobiles, or television. It's the manufacture, refinement, and distribution of anxiety. So as you're watching TV and you're watching the evening news and don't get too worried. Things I think are a little better than you might think. So let me kick it back to Caitlin. And we do have some time for questions and comments. Oh my gosh, it's 2:45 Denver, and I think we timed this right on the minute.
We are right on, Mike. Thank you so much for the information today. It's always fabulous to hear from you on these quarterly calls. We'll go ahead and take about the next 15 minutes for some Q&A. So the email address is on the screen, investment.team@triligyfs.com. If you would like to send in your questions, I've already got a couple. So Mike, we'll start there and see if we get some additional ones. Let's start with the Strait of Hormuz. We know that it has broad impacts, the fact that it's been closed. So while we talked about tax refunds potentially providing an offset for high gas prices, that doesn't impact everyone in the same way. So
Yep.
in terms of the Strait of Hormuz and the fluctuation of gas prices, what are some of the most likely scenarios with regard to the strait being reopened, and how do we expect that to impact gas prices for your average person?
Okay, the pessimist would say whatever the ceasefire is going to look like, it's going to go back to all-out war. There's going to be more bombing of the infrastructure, which lead to higher oil prices longer term. We always say that the cure for high prices are high prices, and then people drill for more oil that brings the price down. The cure for low prices are low prices. The problem is the infrastructure there. And as I mentioned, it's a globally traded commodity. So the price is either North Sea Brent or West Texas Intermediate, and they kind of stick together through thick and thin. The good news, the optimistic news is that the problem is that infrastructure has been destroyed. It's going to take a couple years to rebuild. Who's going to pay for it? A lot of questions there. So I would look for gas prices to not come back down to where they were pre-war for maybe another 2 or 3 years. And that's, I wish I had better news on that. But again, economics is a dismal science, and we got to call them as we see them.
Yeah, absolutely. One of the things that we also talked about early in this conversation today was the midterms. You mentioned the political side, and we don't want to get too political, but there is an impact sometimes on the market.
Yeah.
So what do you expect could be the best possible outcome of the midterm elections as it relates to how we invest?
Okay, that's a great question because I have to answer this question every 2 years. Don't ever invest on politics. You can invest on policies, but not politics. And what we found out, and this goes back way over 120, 150 years or so, the worst markets are when the Republicans have the House and the Senate and the executive branch. The second worst are when the Democrats, and not by much, control those. The best markets are when you mix it, which means not a lot gets done. It's in gridlock. And what we know is in politics and its effect on markets, gridlock works. And you don't need radical changes, whether it's left or right or anything like that. But if in fact the House or Senate does turn over, and using history as a guide, I'm not going to guarantee anything, but that's usually pretty positive for market returns.
Great. Thanks for the insight on that. Let's talk a little bit about inflation. You mentioned that this is sort of a different type of inflation.
Yeah.
And we know that inflation and interest rates are closely related. So do you think this inflation is going to be long lasting? What are your thoughts there? And how do you feel the Fed might react from an interest rate perspective?
Yeah, that's a really good question because inflation can be caused, as I mentioned, by two things, either a supply shock and oil being the most important because everything we have depends on oil. And I'll even say every service depends on oil unless everybody's working on their out of their house. They have to get somewhere. So oil and energy is an input to just about everything we have. Again, if this thing resolves fairly quickly, we could see gas prices coming down, and that would be good for inflation, so the Fed wouldn't have to do anything. What does worry us longer term is the monetary phenomena of the inflation, which is why I have that government spending chart on almost every presentation I do, because people should be aware of that. We spend a lot of money here, and the joke is, we spend it like drunk sailors. And I apologize if there's any drunk sailors out there because they're spending their own money. We're spending now our grandkids' money, and if that doesn't get solved some way somehow, that monetary inflation is certainly hard to get rid of in the system, which would lead to some raising interest rates to fight that inflation. Which lead to slowing of the economy, slowing of opportunities, making things more expensive. I will tell you, though, the new Fed chairman coming in, people think that it was completely political, but I've talked to a couple of solid economists, and they tell me Warsh in the long term is actually more of a hawk than a dove, meaning he's more concerned about inflation and keeping things a little tight than he is keeping things overly loose. So that's good. But what's baked in right now, and this is just a recent over the last week or two, is there may be one rate cut by the end of the year because the market is pricing that this war is going to be short-lived.
Okay. Thank you for that.
Mhm.
You mentioned as we're talking about inflation, we know that gold is generally used as an inflation hedge. We saw some change recently in the euphoric rise of gold and silver,
Mhm.
and it seems like it's maybe slowed a little. You referenced the commodity super cycle. In terms of precious metals and commodities and owning these things in our investment portfolios, is it still a good thing to have right now?
Yeah, it's underowned. And what's interesting is the theory is 98% of all the gold that was ever mined still out there in the system. And you can only mine so much, which is just a small percentage of what is already out there. So you have a couple things could happen. Is number one, you have another shock to the system. People get nervous and they go into gold, and it's happened again for 5,000 years. Now, is gold worth anything? Well, it's kind of like diamonds. You can't eat it, you can't drink it. There are few industrial uses for it because it's so expensive, but it's worth something because people think it's worth something. Now, if portfolios and what we've seen, it's incredibly underowned institutionally and incredibly underowned for private clients and retail wise. So if institutions said, boy, we think this commodity super cycle is a real thing. We need to increase the commodity exposure of our portfolios. Even a 1 or 2% position in our country with the big pension funds and the other big funds, that would move the price of gold materially to the upside. So, is there a downside? Certainly, there's always a downside with everything you do. But the way we see it, we like it longer term. We're not going to have a huge amount in gold. I could see us maxing out at 4 or 5%, but just as a hedge for some type of really bad scenario out there that's not apparent right now.
And what's the thinking around why it's underowned?
It's just hard to own. That's a good question. There's a couple ways to own it. You can have the physical gold, but then you've got to put it in a vault, you've got to insure it, and you have to store it. So the price goes up, you make money. The price stays flat, you lose money because you have to store it, insure it. The price goes down, well, the price goes down. You're not going to make money on it. You can do it through the futures market. That's not quite betting on the spot price. Not to get too wonky, but it can go into normal backwardation or contango. There's storage costs that are factored into the futures market. You kind of have to be more right than the financial markets to make money on it. And it's just a very difficult asset to own. People can go into an ETF, but what they don't understand a lot of times is you don't own the actual gold bars. You're actually trading futures. So it's not owning gold. It's like a commodity future type account.
Yeah, that makes sense. Thanks. Let's pivot to talking a little bit about AI. This is
Mhm.
something that I think we probably talk about on every call, but it's a very prevalent conversation to be having right now. In terms of AI and the job market, what do you
Yep.
think, broad scale, what do you think the big impacts will be to the job market in terms of
Yeah.
industries that are maybe safer or industries that are more likely to be impacted or replaced?
Well, the safest are going to be the trades. I can't see a computer putting together a data center with all the complicated wiring that has to be done. I can't see a computer being a plumber or fixing your car or anything like that. And I think those jobs are going to do well. I think some medical jobs are not going to do well because the medical business is just completely bloated right now. And AI is going to be able to take some of those jobs. Also, our sources tell us that some jobs in finance are going to be replaced by AI. Fortunately, not our advisors because relationships will trump everything. You still need somebody with knowledge and experience to talk to and to do the planning at all. But I think, whatever I say right now, it's going to change in 6 months. So I would encourage everybody, maybe under the age of 40, get to know it, get to understand it, and get to be able to use it and bring value by using it to your employer. The people we hire right now, we'd love to see them have a background, some kind of background in AI, and that's going to be an interview question for the people we hire. How are you going to bring AI into the mix here? Because you don't want to ask somebody like me, these younger people have forgotten more about it than I know. And it's going to be interesting, but it's going to also create some jobs out there. And we just got to find out what those jobs are and how to take advantage of those.
On that same line, we know about the trades, right? There are certain things that a computer screen can't take care of or that code
Yep.
can't necessarily do. Robotics advancements have been amazing in the last couple of years, right? And so there could be a world where robotics is responsible for certain trade level jobs. It seems like that might be quite far away because it's not cheap to create robots
Yeah.
and install them.
Yeah.
But what are your thoughts on how potentially robotics might come into play given where we're at right now with AI?
Might be a little out of my swim lane, but pretty big. It's amazing what they're doing. I had a call this morning for one of our from this group strategist who manages some money for us in a thematic way. They have invested in robotics and actually space, which gets exciting. We can talk about that next quarter as that theme continues to develop. But that does certainly get pretty exciting, and you know, probably some futurists can tell our clients more about it than I can right now.
That's perfect. I just wanted to ask you the question and just get your thoughts. That's what we're here for. So,
Yeah.
Mike, thank you so much. Thank you
So
for
wait, one
sharing.
more thing.
Yeah,
There's
sure.
one slide I didn't put out, and it came from the Financial Times, and it talked about gross domestic product of the world. And then in about 10 years, it made a couple of hypotheses with AI, and that's going to go up. The complete optimistic scenario is we'll be working, one day a week, and then everybody will have everything they want. And then the pessimistic scenario is total destruction of the human race. So the answer is going to be somewhere in the middle there. And I don't know if I'm the one to answer it. So
Yes, of course. That's that's a wide variety of options, but anything can happen, right?
yeah.
Mike, thank you so much for sharing your reflections and your thoughts on what's happening in the markets, the economy, and the world today. To those of you joining us, thank you so much for your time. We are grateful that you joined us today, and we hope you learned something. If you have any questions after the call today, please feel free to reach out to your financial advisor. You can also reach out to us at investment.team@trilogyfs.com, especially if you don't have an advisor, and we're happy to connect you with somebody who can support you in your financial journey. Our next quarterly market commentary call is on Monday, July 13th at 1:15 p.m. Pacific time. An email is going to go out this week with today's recording so you can rewatch it or share it with your friends. And the registration link for future sessions will also be included. Thank you so much, and we'll see you next quarter.